Compliance officer. Good to have you on the show. So, as SBF has stepped down from FTX, John J. Ray III, who's actually worked on bankruptcies for Enron, not a great name to be associated with in this case. But as we're sort of seeing all of this play out, a lot of people are wondering, in terms of regulations, there are existing regulations. Why didn't they do enough to stop this?
Oh, great question. Look, the bankruptcy highlights a lot of the market structure issues, including the lack of regulatory clarity or a workable regulatory framework here in the U.S. And it's driven many of the exchanges overseas rather than the U.S., where we have great consumer protection and bankruptcy protections, right? The guidance we've had in the U.S. has pretty much come from enforcement actions and investigations, which is a little too late. Here in the U.S., we have trust companies, we have banks, we have broker-dealers, right, who are required to fully segregate customer assets, not commingle customer funds, provide audited financial statements, and have AML and fraud monitoring obligations. We have both FDIC and SIPC coverage. And so I think the best solution is to put those exchanges, require them to hold with an independent qualified custodian of those assets, so that you can take away some of those fraud potentials and the potential for bankruptcy that we just went through with FTX this week.
Jeff, I want to take a step back here. I worked with the SEC many years and careers ago, so I understand the process. And what struck me about the rise of DeFi and crypto over the last couple of years, specifically with respect, a lot of companies in the U.S. wanted to be able to pay their customers interest, as is done internationally. But the SEC squashed that, and a lot of these companies tried to work with the SEC. Some of them got subpoenas for their efforts. Your former company Coinbase. I'm not going to ask you to comment on that in particular, but do you think that there's been a comeuppance, that the crypto industry is hiring the right people to understand the seriousness with which the regulators themselves attack and see this market?
Yeah, no, I think we have a bunch of adults in the room trying to figure out the best way forward. We've had ongoing conversations with both legislators and the regulators to figure out a sensible path forward. Coinbase was restricted from offering their yield product, but that's not some of the same yield products that others like Celsius and Voyager, have material issues with. I think the regulators have not figured out a sensible path, and I don't think we need to call everything a security or every token and coin a security to figure out how do we get proper risk disclaimers and disclosures so that consumers can be fully protected or understand what their risks are. I'm not sure what it's going to take. How many more bankruptcies do we need to have before we can get this right?
Good to see you, Jeff. Yeah, interesting that Maxine Waters, who's the House Financial Services Chair, and her likely successor, Patrick McHenry, have both made statements about further regulation coming, but it's kind of ironic, isn't it? SBF was the one calling for regulation on Capitol Hill. If some of those things that, again, ironically, he was calling for were put in place, would it have stopped this?
Look, it's hard to stop a fraud. It is able to put some guardrails up that trust companies or banks who have formal obligations to segregate those customer assets and would be audited, those frauds would be found a lot earlier. So it's very hard to stop someone from doing something fraudulently, which appears to be the case with SBF. As an industry, we are looking forward to regulation. We think the more clarity we have can bring some of that innovation back into the U.S. and make the crypto ecosystem safer for all that want to participate.
And Jeff, in terms of global regulation and the role that plays, when you have companies obviously have U.S. holdings, perhaps potentially allegedly commingling then with their international arms, how close are we to getting some form of global regulation on this, and how important is that?
Well, I think it's important to have global regulation. Otherwise, we're playing a game of go to the path of least resistance around the globe. Right here in the U.S., we have the strongest consumer protection laws. That's a good place to start. I've been working with the FATA for over 4.5 years on some of the fundamental global AML and KYC standards. We still don't have that around the U.S., and we definitely don't have the right requirements of how do you hold customer assets, how do you ensure that they're not commingled. The blockchain gives us great transparency where those proof of reserves can be validated, but we just haven't gotten there yet. And I think the best way forward is to require exchanges to keep their funds with an independent, qualified, and regulated custodian. Not everybody who claims they're a custodian is actually regulated. Our firm is a trust company in South Dakota and in New York, and we are audited and reviewed by some of the strongest regulators, here in this U.S. country.
Jeff, I'm wondering if that's enough. If I look at the history of exchanges, how they evolved over hundreds, if not thousands of years, the most popular model probably has a risk-sharing mechanism where the members of an exchange share counterparty risk in total for whatever goes on. One or more of them may fail, but the system as a whole is designed to be able to withstand a lot of those shocks, and it's worked. Is there a crypto equivalent? Because it seems most of the exchanges are just broker-dealers that also happen to be exchanges for one proprietary token or security.
Yeah, well, a great example here in the U.S., the New York Stock Exchange and the NASDAQ, they're exchanges, but they're not also custodians, right? That's outsourced to clearing broker-dealers and ultimately to DTCC. Here we have commingled between exchanges that operate both as a trading arm, a clearing arm, as an exchange trading arm. That's probably not the best model long-term. So I think we need to figure out what is the right separation of duties to make it safer.
I just want to quickly ask you, obviously, when you have a big personality like an SPF, and he's only 30 years old, but we saw so much reliance, not just by retail investors, but institutional investors as well. Talk about the cult of personality and the role that you think this has played in some of these big players in the crypto industry.
Hey, back in the day, everybody trusted Bernie Madoff, right? He was one of the pillars of the NASDAQ and the society, and you put trust in that. But sometimes you have to trust but verify and actually do better due diligence. I've met with regulators in Washington for the last 4 years, and we're trying to find a path forward. And there are some good actors in the space, but sometimes they're bad actors, and it's hard to find out, who are the good actors when they're putting on a good show. I'm not sure when this fraud started. I'm not sure if it started, during the Three Arrows failure and SBF stepping in to try and plug some holes in Alameda Research's books. But I think he had good intentions and maybe have gone off the rails somewhat.
All right, Jeff Horowitz, great stuff. Really appreciate you being with us here.
Google を選ぶ、Galaxy を選ぶ。どんな時だってスマホのセキュリティを気にしていたら楽しめない。Google Play Protect が24時間有害なアプリから自動で守る。Galaxy with Google。
Welcome back, and let's get a check of the markets on the Wi-Fi Interactive. We have the Dow, the only major underwater. We can see it's down about 47, almost 37 points right now. S&P 500 up about 2/3%, and NASDAQ up 1.5%. Let's check on the 5-day action here. You can see up 7.6%. And for more on the broader markets, we're joined by Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Victoria, always great to see you here. We've been talking a lot about crypto, but there was also a little other news during the week. We had a huge CPI report that produced an outsized reaction in not only stocks but bonds. What's your gauge of this?
Yeah, I was actually kind of surprised to see such a huge reaction coming out of the CPI report. Obviously, we knew that inflation was going to start to trend down. Some of that easy deflation that people were looking at as supply chains improved, so we knew, apparel would be better, used car prices would be better. I actually thought we would see more of a spike in the services component of inflation that would counteract some of the goods decline, but actually things held pretty well, and so we had that better than expected number. Again, I think the market maybe got a little bit ahead of itself, thinking that this is going to change the path that the Federal Reserve is going to take. I really don't think it does at all. I think they're sticking with a 50 basis point hike in December. They're going to continue to push until they get to that terminal rate somewhere around 5%.
And we're seeing investors pulling out of some of these more defensive plays like healthcare, utilities right now. But how long should people be holding the defensive stocks? Should they not be taking the foot off the gas just yet?
So, Rochelle, I think they need to have a little bit of that in their portfolio regardless, right? We were adding to those names. HMOs was something that we really liked previously, adding some of those defensive names to our portfolio over the last few months. That was something we thought was pretty prudent, especially with the idea growth is continuing to slow and the Fed continuing to push and probably into maybe a small recession around spring or summer of next year. However, what we started doing a couple weeks ago was adding some more cyclicality to the portfolio. So I do think investors need to do that. Take advantage of some opportunities to add some of that cyclicality, add a little beta to your portfolio, but don't completely change your strategy. Keep some of those defensive names because, look, we're going to continue to have volatility, whether it's from the Fed, from geopolitical issues, from the events that happened today that we saw. So I think there's a lot of elements to bring volatility to the market, and you need a balanced portfolio.
Yeah, and to that point, do you expect any direct impact on the equity markets from the downfall of FTX or eventually any institutional money ever flowing anywhere near crypto?
Yeah, I think people are going to be much more cautious going forward. I mean, obviously, when we look at our equity portfolios, we have a values-based component that includes governance issues. To catch securities where we don't like the governance components, we would need to check the balance sheets. We would need to like their business models. So we haven't been involved in this sector at all because of those elements in our process. But I do think, like I said, things like this bring volatility into the market and uncertainty. There's going to be increased talk about regulation, especially if we see the House changing and we have a divided government. There'll be more regulation talk going on. So I think it'll bring more volatility and more concern for investors going forward.
Hey, Victoria, I agree. We can't call this a pivot or anything close to it, but I want to pull up the Wi-Fi Interactive and show you the price action for the week. By far and away, the biggest beneficiaries of that huge outsized action yesterday, and it looks like, let me see if I can pull this up here, was tech, up almost 10%. And as I get this, there we go. I'm sorry about the presentation here. There we go. Tech almost up 10%, followed by communication services. Should investors count these out, or is there still a chance of life? A lot of investors still sticking in with a lot of the growth names that were hammered, not necessarily the bigger ones like Apple and Amazon that we expect to be mainstays, but should investors really just start reorienting themselves towards the cyclicals, or can they still maintain some of that older growth portfolio?
No, Jared, they can maintain some of that portfolio in there, but I would be very careful when it comes to these large tech names. I mean, obviously, we had the 10-year Treasury drop, 26 basis points in one day. I mean, it was an incredible drop. And those longer duration stocks are really going to benefit from that. And that's exactly what we saw with the tech names. So the fundamentals didn't change. A lot of the concerns about exporting our technology, concerns about sales being pulled forward and chip issues, none of that changed because of what happened with the CPI number. So I would be very cautious in jumping in and trying to chase any names. But again, keep that balanced portfolio, have some growth, have some cyclical, and I think you'll be able to weather the volatility through the rest of the year.
And obviously with that one CPI print puts a little bit of pressure on the Fed to perhaps try and ease back. But as the Fed says, they need the consistency of seeing inflation go down. But in terms of some of the things that are outside of the Fed's control, you mentioned geopolitical issues. What else is going to be weighing in terms of volatility?
Well, I think obviously the midterm election was a huge thing that we wanted to get through, and we actually don't even have the answer to that yet, Rochelle. We're still waiting for that. So we could have some volatility anticipating. We mentioned the geopolitical issues that are going on. We have the G20 meeting coming up next week. Obviously, I think if we see other central banks pushing even further and hiking more than expected, that'll put more pressure on the Fed to do what they need to do. And look, next week has a ton of data coming in and earnings. We've got retail sales. We've got tons of retail earnings coming in. Home Depot, Lowe's, Walmart, Target. Lots of news on the consumer, and that's what's really holding up the economy. So if we see some of those things start to falter, then I think we could have that additional volatility you're talking about.
joining us now for more on the FTX fallout is Scott Melker, the Wolf of All Streets podcast host. Good to have you on. Obviously, a very tough time to have to be on the show. So I want to get your reaction first. A Chapter 11 filing, SBF resigning as CEO. As someone with skin in the game, where are you in terms of how much this is shaking your faith in not just some of these platforms, but the tokens as well?
I would say it's shaken my faith absolutely zero in the actual asset class and technology, but hard to say the same for the actual platforms and infrastructure that's been built in the crypto space. I mean, what we have here is a slow motion train wreck running into a dumpster fire that's full of black swans. This is about as bad of an event as we could possibly imagine, because this is the biggest platform on the largest stage with the very person who is speaking to Washington regulators and legislators of this industry. As I said, the asset class will be just fine, but it's going to take quite a while for the actual industry to recover.
It's a circular firing squad at this point, Scott. Who do you blame the most? Gary Gensler certainly taking some heat at the moment.
It's hard to place blame, and it's very easy to do that, I think, in hindsight. I think that there is some blame with the SEC and regulators for not offering clarity and pushing the entire industry and all of these investors offshore, making them find shadier counterparties to do business with. Also, the very fact that we only had GBTC for people to invest in, and an ETF was never approved. Really very little clarity and very little protection for consumers with superior assets. But at the end of the day, you have to blame hubris, greed, ego, humans, right? We had a bunch of very young people who were empowered, backed by the biggest money in the industry, who basically felt like gods and like they could do anything. And we all know how that story ends. We've seen it repeatedly, and I think it's just a massive disappointment that it ended this way with SBF, who really was viewed as sort of the white knight of the industry.
Scott, this is highly reminiscent of me personally for the bankruptcy of MF Global that took place almost exactly 11 years ago. I remember that the day after Halloween, I think that was when they did the filing, and it created chaos in the futures industry. And this was a well-regulated industry, very entrenched, and it took years to sort out. I'm just wondering, who are you talking to? Who are the experts you're talking to? Is there any sense that people are going to come together to try and find some kind of common ground here in terms of a legal defense, not legal defenses, but customer coalitions to try and get some of the money returned to those people who lost it and who should be first in line are probably last?
I think that's an interesting question, and right now I believe it's a bit chaotic, and that's because all of these parties are somewhat separated. And to go back to my former point, we're looking at FTX filing Chapter 11 bankruptcy in the United States, but only FTX.US operates in the United States. FTX is actually an offshore entity. So I think that this is much more complicated because they are not actually entities that are regulated inside the United States. I mean, you talk about obviously Corzine, and I believe all those investors eventually were actually made whole. That is not going to happen here. I mean, let's be frank. That is not the reality here. We're talking about a $16 billion entity that has a $10 billion hole in the balance sheet.
We know there's a lot of Monday morning quarterbacking about people who say they saw red flags, but I mean, you also had some institutional investors who clearly must have done their due diligence, at some point for us to get to this point. But for a lot of investors wondering then, where are the safe places or the reliable exchanges? As you try and discern that, how are you supposed to be able to discern that at this point?
I think that it's become far more difficult than it was before. To your point, you don't get investment from BlackRock and Sequoia and teaching the Ontario Teachers Fund without due diligence. So I believe that when that last round of funding happened, probably the books were in order and all of this started to really go down in April, May, June when Three Arrows Capital collapsed. I think that's really where we're seeing the contagion here. As for what's secure, it's a very, very obvious answer, and it goes back to the very ethos of Bitcoin. We won't talk about crypto. Let's talk about Bitcoin because it's very different. Not your keys, not your coins. You can buy on an exchange, but the safest way is to take any coins you're not actively trading or using, put them into self-custody, and become your own bank. That's literally the reason that this was invented. We lost sight of that to a large degree as an industry and built basically a replica of 2008, the financial system, but with inferior rails and no regulation. There was only one way, in hindsight, as the Monday morning quarterback, that this could have ended. And I think that the silver lining is that it will come back to the original ethos and importance of buying Bitcoin as an asset and custodying it yourself.
Another Bitcoin bull like yourself, Scott, is Mark Cuban, the Dallas Mavericks owner and the tech billionaire. He spoke about this yesterday at the Sports Business Journal Dealmakers Conference. Here's what he had to say.
First, you've got to understand crypto. There's speculation, right? That's all the noise, right? Then there's things that have happened with Voyager and with FTX now. That's somebody running a company that's just dumb as greedy, right? So what does Sam Bankman do? He just give me more. So I'm going to borrow money, loan it to my affiliated company, and hope and pretend to myself that the FTT tokens that are in there on my balance sheet are going to sustain their value.
Cuban went on to suggest there could be criminal charges eventually, depending on what exactly happened here. What's the next shoe to drop? What's the next domino here?
I have no idea if there's going to be criminal charges. I'm not a lawyer, but I can tell you that we're talking about the Great Recession in 2008. You don't see many people in jail. And a lot of the people that we've seen in the crypto industry who have been bad actors and have been a part of this contagion in the past are off surfing and writing long-form blog posts about their emotions. So I don't have much faith that we're going to see very much punishment, certainly for any of these offshore entities. As for the next shoe to drop, we already saw BlockFi last night. It's a very circular industry, as you know. I mean, there's conjecture that BlockFi took that FTX loan for $400 million and loaned it back to Alameda Research to gain yield. Now, I can't tell you if that's the fact, but we do know that those kind of things are happening in the industry. I would expect there to be major fallout, a lot more institutions, especially the hedge funds and investors, just absolutely falling apart in the future. But that doesn't mean very much for the future of the asset class, in my opinion. At this point, I think we would rather just liquidate and get rid of all of the bad actors and move on.
Welcome back, everyone. Let's get a check on some of the major cryptocurrencies today, as we've been keeping a close eye on them throughout the week. We are a little bit mixed right now, but Bitcoin, you're seeing that down by about $290, 1.7% here over the past 24 hours. Ethereum, or Ether, that's down by about 1.4%. But you've got some bright spots like FTX token, interestingly, well, it's also fast, I suppose. And Solana, you're seeing that's getting a bit of a reprieve. This is FTX's dramatic fall continued with regulators in the US. In EU, they're putting the squeeze on its subsidiaries. The news capping a tumultuous week in crypto, starting from a liquidity crunch at FTX and now strapped bailout from rival Binance. Let's take a deeper look into the space with Caitlin Long, Custodia Bank founder and CEO. Caitlin, great to have you here with us this morning. First and foremost, if we have to wrap up what has taken place this week for us, you know, what is the way that you describe this to somebody who is just trying to figure out what's going on in crypto right now?
There was a massive amount of hidden leverage in the crypto markets that built up over the bull markets, and it's being flushed. And good riddance to it, to be honest. I know it's causing a lot of pain for individuals, and I don't wish ill on anyone, but this was inevitable and foreseeable, and here it is. Let's just get it done with and be able to build again.
Caitlin, is regulation, you think, a good thing for this industry? We've heard this for a couple of years now, notably really being championed by Coinbase's founder and CEO, Brian Armstrong. But could cryptos go up if the government is going to come out here and hammer the space?
Yes, I think this is one of those situations where it's a couple of steps backwards and then potentially a step forward. I know there are some purists in the industry who really don't want regulation at all. But the reality is that into the void of lack of clarity of regulation filled a whole slew of scammers, fraudsters, and risky business models that would never have been allowed had regulation taken place. There are a number of companies like myself, like Custodia Bank and others, that have been knocking on the regulatory door to get bank and broker-dealer licenses in this country for years. And they have not been successful. And into that void filled an awful lot of bad actors, unfortunately.
So who are the good actors left in crypto?
Well, it's the folks who frankly didn't play these leverage games. It's so interesting how many of the folks who've blown up in crypto were ex-Wall Street traders. And they came in thinking that crypto is really no different than any other traditional financial asset. and applied some of the trading strategies that they learned on Wall Street. And there are, I spent 22 years on Wall Street, there are subtle skimming mechanisms that are not fair to mom and pop in traditional finance, and they brought those approaches into an unregulated crypto market and made, in the short term, big fortunes. But in the end, what they all learned is a very, very hard lesson, which is that it is not possible to leverage Bitcoin more than 1-to-1. The moment that you do that, you are insolvent, and it's only a matter of time before the liquidity crunch gets you. And that when the liquidity crunch happens, all it's doing is revealing an insolvency that was there all along. There is no difference in crypto between a liquidity crunch and an insolvency. And the fundamental reason for that is really simple. There is no central bank that can act as a lender of last resort. There are no bailouts, no concept of privatized profits and socialized losses. When they blow up big, and let's get rid of them and allow the builders who have been here all along to continue to build on the technology. This was never a trading game. It was always a technology, and most of the folks who were here for a long time always have never lost sight of that.
Kaylin, those are strong words, insolvency, but it takes me back. We've been talking all week long about the financial crisis. To that point, is there a future for this industry, and what is that future?
Oh, yes. Actually, it links the first two stories that you had this hour, the crypto collapse, but also what's happening with Twitter. The signal through the noise this week is that Elon Musk announced that he's making good on what many of us thought the Twitter acquisition was all about all along, which is payments. And he's going to allow peer-to-peer payments among Twitter users around the world. He will not be using traditional bank payment rails to do that. So those of us who are building on the technology, we've been around for a decade and weren't here for just this simple, trading flash in the pan for the last couple of years. All of us got excited about that. That's the signal through the noise that broke through this week.
Caitlin, I want to get your reaction to some news that's just come across as FTX has filed for bankruptcy, saying in a statement here that they're going to commence voluntary Chapter 11 proceedings in the United States and begin an orderly process to review and monetize assets for the benefit of global stakeholders. It goes on, but is this something that you expected to happen? And as we continue to see some of the downfall or the fallout of FTX, what takes place next at this point in time?
Yeah, Fred, Kaylin, real quick, I should note as well, Sam Bankman-Fried has resigned his role as CEO. He is just now assisting the company in this orderly transition. But, like Brad just mentioned, Kaylin, do you see other crypto companies filing bankruptcy here?
Oh, sure. And again, good riddance to them. These were the leveraged players who were just rolling the dice. This was a casino, and these were companies that really don't have anything to do with the underlying technology at all. The Bitcoin blockchain continues to add blocks every 10 minutes on average. It doesn't care what the market structure and what all this leverage mess was all about. And so good riddance to it all. I'm not surprised that the bankruptcy filing came. There were a lot of bankruptcy attorneys speculating whether the filing would happen offshore or onshore. It's going to be probably the most complex Chapter 11 filing in U.S. history, given all of the offshore companies and given the ambiguity in the law about what crypto assets even are in the United States. There's even been some talk on the Hill about potentially getting a crypto bill passed before the end of the lame duck session and staying this bankruptcy because of the ambiguity in U.S. law about what digital assets even are. That this is going to be a very difficult Chapter 11. I would guess it will take years. And just like in the Celsius bankruptcy, there were 29,000 individuals who were doxxed by the bankruptcy court because they're unsecured creditors. That's going to happen here as well. There will be thousands of individuals whose personal information, unfortunately, is going to be listed in the bankruptcy court filings as a result of the fact that they're unsecured creditors of this Chapter 11 filer.
Does what's played out with FTX this week remove any possibility for crypto moving forward in some other developed countries that have been kicking the tires or at least evaluating what blockchain or what crypto could mean for their economy?
Absolutely. These crypto winters, I've been in it for 10 years now. This is my third crypto winter. Everyone always spells the death knell. And it's because of the excess. It's in part because it's an unregulated industry and the mercenaries could come in like they did and leverage it up and then have these spectacular crashes. But the rest of us who are here for the technology and have been here all along are continuing to build. And the amount of activity, just last week, there's something called the Lightning Network, which is a second layer Bitcoin protocol that allows the transfer of US dollars for essentially free and essentially instantly anywhere in the world. And I saw a South African grocery chain, Pick and Pay, has just integrated with the Lightning Network. And McDonald's in Switzerland just integrated with the Lightning Network. These are real payments use cases for the actual technology. That's what I'm bullish about. And again, watch Elon Musk, because the Lightning Network is already integrated into Twitter. And so he already has that tool to be able to flip the switch. That's the sort of thing that will take off in the next bull market. These bear market cycles, and what I'm alluding to here is Bitcoin goes through 4-year cycles where we're at the typical bottom of the bear cycle, and they're tied to what's called the halvenings, where Bitcoin's inflation rate gets cut in half every 4 years, and Bitcoin gets enforceably more scarce. And that's going to happen in approximately March 2024. That sets up for the next bull cycle, and I expect that payments will be the next big thing. Thank goodness that's more sustainable than the crap we've had to deal with in this industry in the last couple of years. Good riddance to it all.
All right, way to bring that fire for us there, Caitlin. Again, reporting right now, FTX just filing for bankruptcy. Sam Bankman-Fried, the one-time billionaire leader of FTX, now he has resigned, handing over his post to assist in this process. We also saw a tick down. We're just showing on the screen crypto prices. They were holding up in the early going, now have ticked lower. Custodian Bank founder and CEO Caitlin Long, thanks so much for the perspective. Have a great weekend.
簡単申し込み
スマホ PC で簡単申し込みみずほ銀行カードローン
Everyone, let's talk more about the crypto chaos. Dan Dola, Mizuho America's Managing Director and Senior FinTech Analyst. Dan, just encapsulate this week for us. What has been continuing to play out in front of your eyes, especially with the newest and the latest out this morning that FTX is going to be filing for Chapter 11 bankruptcy, plus SBF stepping down?
So I want to say, nothing for me to do on Singles Day. So sorry about that. But beyond that, talking about crypto, I think this week kind of tells us, or anyone that didn't think that, those tokens are worth pretty much nothing, now realize that. And I think it's going to take time. I'm thinking whether this is the Bear Stearns moment or the Lehman moment, if you go back to 2008 of crypto. And I think we're somewhere in between that, because, if you didn't wake up to Luna and you didn't wake up to Three Arrows, this should be a wake-up call that, what you thought was worth something is actually not worth anything, and things change overnight. So I think that's a big red flag for Coinbase from a stock perspective.
Dan, it's been a long week. I just got your joke. For me, I that's what I'm rolling with. Nothing on here. But
it took a while. It's
been a long week just covering all this crypto stuff, as you can imagine. Look, what do you think the fallout here means for crypto as a payment function?
I think it means that actually not crypto, but a stable US dollar is actually the answer to payments in crypto. I don't think Bitcoin is the answer. I don't think any of these tokens is the answer. So I think basically it takes, what at least it does is it tells us where crypto is not going to. It doesn't tell us where crypto is headed to, but it tells us where crypto is not going to, which means that these tokens are basically, a lot of them, most of them are going to expire worthless at the end of the day. And the trading volume is going to come down because the users are not coming back anytime soon once they get burned. So that's why it's bad news for Coinbase. So I think that if you think about the gospel of it, I really believe in the US dollar and digital coin, whether it's a Circle minted or it's a government minted. That's the answer, because it basically puts the US dollar on the blockchain and then you can transact internationally. That's probably where it's headed towards, but it's going to take some time.
How quickly do regulators need to act when it comes to crypto?
Well, there's still about $1 trillion, I think, of so-called market cap on this. I think fairly quickly, because I think there's a lot of money that's still tied to a lot of these tokens, and if God forbid we're going to see more of these things, then a lot of people are going to lose a lot of money. So I think there definitely needs to be regulatory action around that and clarity about what are assets, what are not assets. Those are all things that need to be resolved.
Dan, as you think through this, over the next couple of days, what should investors be prepared for? What should they be on the lookout for?
I think, again, my own opinion is that there's going to be worries about, even I mean, right now, Bitcoin, you're seeing what happens with Bitcoin, right? Bitcoin is kind of the bellwether for everything. So I think what investors should be prepared for is we did some work. This is actually sort of proprietary work that we've done. We've done work on the Coinbase platform. The average cost basis for Bitcoin is about 20,000. So we've run two separate surveys. 20,000. We're now at, I'm seeing on the screen, less than 17,000, which means that more than half the people, again, according to our work, are, basically losing money, right? They've lost like 15% on average. And what that means is that at what point, and $10,000 is kind of that sort of point, that another like big inflection point where people are making decisions. Should I stay or should I, fight or flight? And I think that this range between 10 and 20,000 is a very dangerous range, because a lot of people are saying, like, if it doesn't go back to when you're at the money anytime soon, I think a lot of people are going to basically just give up. So I think I would watch the price of Bitcoin very carefully, and just knowing that 20,000 is a benchmark. That's a very important benchmark, because a lot of people are invested at 20,000 again, according to our survey work.
Okay, and so for all of the tertiary players that are already publicly traded and are relying on people to continue to flow funds into crypto, whether that's a Coinbase and what we've been tracking with their stock, whether that's a Robinhood, how does this impact them?
I mean, in terms of like those companies that are doing that? So I'm very cautious on Coinbase, right? Because hopefully that answers your question. I'm very cautious on Coinbase, because think about how they make money. They make money off of commissions. So if you stop coming in and trading, right? If there's disinterest, or if you're not trading as much, they don't make money. So they're very vulnerable to disinterest in crypto, right? The worst thing that can happen to them is that people just lose interest in this category. When people lose interest in the category, whether they sit on these tokens or they sell them. Well, if they sell them, they're going to get sort of one-time hurrah of volumes. But let's say if they don't come back, or if they sit on these and just say, like, I'm not playing this for the next 5 years, it's pretty bad for them, right? Because that's how they make money. For Robinhood, it's not as bad of a problem, because only like 14% of their revenue comes from those tokens. Remember, Robinhood is mostly a broker. They have equities, they have options, much more diversified, and they don't really rely on those commissions to make money. So it's a big problem for Coinbase. It's not as big of an issue for Robinhood.
Dan, real quickly before we let you go on Coinbase, given what we are seeing in crypto, how's their liquidity situation?
So I think they're fine. Again, from what we've seen, they're fine. And I think they were very outspoken. They don't have any exposure to, or any real exposure to FTX. So I think from a liquidity perspective, we had concerns heading into the third quarter, but I think those concerns were resolved. So right now, I think the liquidity is not their problem. Their problem is that just the way they make money is reliant on these people, on people continuing to trade these tokens. And when people stop trading those tokens, they don't make money, and their cost base is still very high. So that's their problem, not the liquidity right now.
Got it. All right, Dan Dahl of Mizuho, America's Managing Director and Senior FinTech Analyst. Always good to talk to you. Have a great weekend.
My pleasure.
The whole industry is going through a pretty big shakeout right now, and that's, kind of causes tremors across the industry, no doubt about that. But ultimately, what this situation lays bare is that there is a pretty meaningful difference between the sort of security and trust that you could count on with regulated exchanges and the crypto companies that are operating kind of heavily within the regulated ecosystem versus ones that are operating in the unregulated or sort of semi-regulated space, which is what FTX and, for that matter, Binance do as well. So as much as this is painful, will cause a shakeout and causes, some sort of tremors and concern about the stability of the overall industry, ultimately it will likely mean a flight to quality, which should be good for Coinbase and its more regulated peers.
The regulatory fallout from the collapse of FTX. We want to bring in Sultan Megji, a former FDIC Chief Innovation Officer. Sultan, it's great to have you here. So we talked about what this means from an investor perspective. Now let's take a look at what this means from a regulatory perspective, because up until this point, we haven't seen regulation within this space because of the fallout from FTX. Do you think we'll finally see some regulation come to the crypto industry?
Well, there has been regulation, and it's mostly regulation by examination. So the SEC in particular has used its existing authorities to examine and enforce certain actions in and around crypto. You've seen it from the banking regulators as well within the chartered banks of the United States. But to answer your question, it would be fantastic if we actually got some regulatory clarity here. You know, there are a lot of places where there just isn't a clear roadmap or rules of the road as to what anyone should or should not be doing. It's like driving down the street and not knowing what the speed limit is.
And it's ironic that SBF was one of the people that a lot of regulators were looking to in terms of helping them to shape regulation in this space. What sort of a wake-up call is this, and where should regulators be looking to try and chart this path forward?
Well, speaking on the other side of the United States, you know, there are a variety of different potential laws that Congress has been working through for a while, and hopefully this accelerates some of them. You know, one that FTX has been very excited about is around consumer protection, but there have been others that talk about where we can actually custody crypto in the banking system. And, you know, there's kind of a push and pull back and forth between the various agencies. So, you know, first we'd be looking for Congress to draw some clarity, because that's really where that should land. And then the second is, you know, I think we all need to pay a little bit more attention to who's lobbying for what here in DC.
So when you take into account, I guess, because you're saying that you saw this coming now for quite some time, with that in mind, are you worried about similar scenarios with other exchanges in the future? And I guess to the regulatory question of this, could regulation potentially stop that realistically?
The answer to both questions is yes. You know, there are a lot of other players out there that are operating, if not exactly the same way that FTX had been, but, you know, that are in a similar space. You know, Sam's tweets today very clearly showed that he thought he wasn't levered, but he was in fact levered. And, you know, there are a lot of organizations that are probably having to look at their balance sheet and look at their operating model in the exact same way. But if we had some thoughtful regulation in this space, that would absolutely be helpful here. And it would absolutely keep things like FTX happening again. Just like in 2008, when Lehman Brothers and others collapsed, new regulations were put in place that have stopped other actions like that from happening. And we need that exact same kind of thing now.
And Sultan, as you have the different agencies sort of vying to see who's going to be overseeing this, what do those two different paths, what do those outcomes look like for the crypto industry?
Well, you know, there's really three options ahead of them. You know, option number one is status quo, which just will lead us down the exact same path we've been down, with potentially the same kind of disasters, you know, happening again, potentially with broader ripple effects across the average consumer base. That's option one. Option two is a ramp up of this regulation by examination and by enforcement by the existing agencies using their existing authorities, which will really, you know, push crypto as much out of the system as possible. And then a third option is to
on that ripple effect. What do you think that potential fallout could mean if nothing is done?
Well, we're seeing a couple of things already. You know, certainly we're seeing a lot of new actions around the prices of various cryptocurrencies, you know, and we're seeing, you know, more variability in that. So that's number one. Number two is we're also seeing, I think, a lot of organizations now having to take a step back and think about what their policies and products and services as it relates to crypto are, especially those that sit outside of the regulatory environment. You know, these ripples can and will occur. And the third is, you know, for those that are operating inside of the regulatory environment or that are trying to operate inside the regulatory environment, I see this as a huge win for those. And so there are a variety of organizations that are kind of doing all the right things and helping the regulatory community figure out what to do here. And I think for those organizations that are working with their regulatory partners, whether it's on the market side or whether it's on the banking side, this is a great opportunity for those organizations to really help lead us into a place where this doesn't have those ripple effects.
And Sultan, when you look at this web of what we saw with FTX International, obviously offshore, but then you have FTX US and how they feed into each other, how much of this is going to be about global regulation as well, given how interconnected this all is?
That is a fascinating comment and a really important one to make, because so many organizations around the world right now are using jurisdictional arbitrage to kind of navigate this. And this is just a great clarion call for us to see far more international collaboration in this space. You know, the Bretton Woods Committee even is working on a future finance initiative right now to help foster some of this. The BIS crowd out of Europe is trying to do the same thing. And it would be fantastic to see far more international collaboration around this.
Well, certainly might get more of that with all this being highlighted. Sultan Megji, thank you so much for joining us this afternoon. All right, well, for more on the crypto fallout, we welcome in Stephen McClurg, Valkyrie Investments Chief Investment Officer. So obviously we're seeing crypto rallying today, getting a brief reprieve based on that better than expected CPI report. But where are we in terms of the fallout from this?
Yeah, thanks for having me. Well, really right now where we are is we're in the second leg of the bottom, so to speak. We hit the first leg in the summer after we had the deleveraging after Celsius Voyager BlockFi from the spring. This is the second leg where we have further fallout from FTX. And what we believe is happening is, you know, FTX tried to bail out Voyager and others because they were tied into it in some way. You know, it was very tough for us to understand how FTX and Alameda were related. We thought it was possible that Alameda was essentially a prop shop in the background for FTX International, you know, trying to earn additional income. So, you know, we've avoided utilizing FTX as a counterparty, as we did with Celsius and Voyager. But the third leg is still to come. So we have a nice little reprieve right here. But the third leg really is going to be some of the fund managers that have used FTX as their counterparty for custody and holding assets. If I were, you know, for instance, in a fund that had a large amount of assets on FTX and got the news that I'd probably be redeeming right now, and I'm sure a lot of other people will redeem. And once those redemptions hit those funds and those funds start having to sell off, that's probably going to be the third and last leg of this sell-off. But at the moment we're at the bottom, and we are getting a bit of a reprieve from macro markets as well.
Stephen, you mentioned some concerns there about FTX. I guess to you, what was the red flag? What did you notice that I guess others in the industry didn't exactly see months ago?
Yeah, you know, anytime that we work with a counterparty, we try to evaluate the risk of that counterparty. So whether we're looking at Coinbase or Gemini or Kraken or some other platform, we do due diligence on the security of that platform, and we also want to understand what are they doing with their custodied assets. In the case of FTX or Celsius, we never really got a clear understanding of what was happening in the back end with those assets. You know, in some cases they have a product where they're delivering yield. Well, where does the yield come from? And you know, there's been a saying for the last year: if you don't understand the yield, you're probably the yield. So when you don't understand risk, you can't take a risk. So we've avoided taking risks that we don't understand.
And as you mentioned, obviously being near the bottom at the moment, what's the best and worst case scenario right now, not just for the crypto industry, but all of these retail investors who are stuck in the middle here?
Yeah, unfortunately, I think a lot of their funds are going to be lost. I really applaud people like Justin Sun, who is coming on and offering ways of getting people their tokens off the exchange, and by supplying some kind of collateral there. I don't understand exactly how that's working. I haven't dug into that yet, but the fact that they're coming out and they're really trying to help you know, people in the ecosystem is absolutely fantastic. But there's a lot of other people that are going to get hurt in this, right? You know, there's the difference between FTX International, FTX US. A lot of people were moving their money from the US into FTX International and trading over there. So, you know, first of all, it's kind of hard to understand how they were even able to do that, because you'd probably have to ghost VPNs and work around the system, and it's probably even harder to understand why FTX would accept those deposits, but they did. And then secondly, it's a big risk that you're taking, and it's unfortunate that retail investors are getting hosed in this.
And Stephen, there's also, of course, the worry out there that this could also signal that maybe similar types of collapses could happen in the crypto markets when it comes to some of those larger players. Are you at all worried about that?
Yeah, I mean that's really the thing that I'm worried about the most right now. This does seem to be the last leg of deleveraging, first of all. So there's not a whole lot more leverage in the system at the moment. I think for the most part, people are out, right? The third and final leg after all this deleveraging has happened is some of those funds, is some of those fund managers that had deposits on FTX they're not getting back, and they're probably going to have to unwind their funds or a portion of their funds in some way. So that will be the likely the final sell-off here. But that being said, I do think that we're at the bottom. When you're at the bottom, it doesn't mean you can't go lower, but we are at the bottom, and we'll probably retest those lows a third time before we rally.
And what does this mean for the future of exchanges? Is it just going to be this idea of just hold on to your own keys, have your own hard wallet? Does this make people just lose faith in exchanges overall?
I don't think so. There are a lot of good legitimate exchanges out there. There's also a lot of good legitimate custody solutions out there. I think people are going to be more cautious about where they go. Just like us, we evaluate every counterparty we work with. So there are trusted exchanges. For the most part, we trust Kraken, Coinbase, Gemini, a couple of others. And then you also have other players that are coming into the ecosystem. There was a big announcement a month ago that Bank of New York is going to start custodying Bitcoin and Ethereum. So, if you're a fund manager, why wouldn't you hold some of your Bitcoin with a trusted custodian that trusts, that custodies trillions of dollars in assets? So that really is the future, in my opinion. The players like Kraken and Coinbase and Gemini, who have been trying to do the right thing all along, who've been playing ball, who operated within the U.S., operated within current regulations, as well as some of the the newer players that are old players and track on.
Certainly a lot to untangle here. We do appreciate you joining us. Stephen McClurg, thank you so much.
あなたのビジネスにあなたと最後までやり抜くパートナー、ドコモビジネス。
All the people who don't know what they're doing are getting wiped out. That's a good thing. Now, it's tough for the investors, but it's okay, because when you take a big spatula like bankruptcy and scrape out the patina of all the idiot managers, you get them out of the industry. That's good. What you're left with is much stronger management, much better business models, much better projects that are well financed, and we can move forward going through that. So when people say to me, what about this correction? It's a good thing. It's a great thing that happened here. And I'm sure there'll be more corrections, but those are people that didn't know what they were doing, and they put on too much leverage and they got wiped out. That happens in every market, in commodities and stocks and bonds. It's happened for decades before. Idiot managers always get wiped out, and that's okay.
We did see that video that was leaked, Mark Zuckerberg addressing his workforce here, talking about how quickly the company grew over the last few years. Is CapEx the next thing that could potentially get cut when you consider how quickly this company's been spending?
Not in the metaverse. If you look at what Mark Zuckerberg said during the last earnings call, they said that, yes, we're spending a lot on the metaverse, but we're going to just ramp that up in 2023, and then we'll slow the pace of that in 2024 and beyond. So they're not cutting back on spending there, which is interesting. I'm sure there are a lot of people who were let go from Meta, those 11,000 or 13% of the workforce, who would say, look, you're putting money into this metaverse that hasn't paid off. We don't know if it's going to pay off, and now it's costing us our jobs while you put money into your pet project. So, there's this kind of different confluence of events going on with Meta that are really hurting it, and most likely the reason why its share price is down near 70% year to date. And part of that is those investments in the metaverse that Zuckerberg is making. It was $10 billion worth in 2021. This year, on track to do the same. So far, I think it's around 17 billion in total that we've seen over the past 2 years. And then going forward, as I said, they're going to be putting more money into that. Then there's the ad market issue. That's just a broader macroeconomic problem. That's not necessarily just a meta problem, but they also have the issue with Apple's iOS privacy changes. They're still working on ensuring they can provide advertisers with enough signals for their ads to ensure that they're getting to the people that they want to see it. So that's still a problem that they have. And then, on top of that, there's the whole Gen Z issue where, according to Forrester, Gen Z is just abandoning the main Facebook app for TikTok. And while they are spending more time on Instagram, they're spending even more time than on TikTok. Reels, by the way, the product that's supposed to be a TikTok competitor, not doing well with Gen Z. So there's this, just multitude of problems that Meta has to work through. And they're doing the cost cutting when it comes to workers. A lot of recruiters were let go yesterday. But, when it comes to the metaverse, they're still plowing billions into it. And it doesn't look like Mark Zuckerberg is going to change his mind, and can change his mind since he's has the biggest voting share.
All the people that don't know what they're doing are getting wiped out. That's a good thing. Now, it's tough for the investors, but it's okay because when you take a big spatula like bankruptcy and scrape out the patina of all the idiot managers, you get them out of the industry. That's good. What you're left with is much stronger management, much better business models, much better projects that are well-financed, and we can move forward going through that. So when people say to me, what about this correction? It's a good thing. It's a great thing that happened here. And I'm sure there'll be more corrections, but those are people that didn't know what they were doing and they put on too much leverage and they got wiped out. That happens in every market, in commodities and stocks and bonds. It's happened for decades before. Idiot managers always get wiped out, and that's okay.
Well, let's continue the discussion with our panel here. John Reed Stark, he's with Duke University's Law School. And Neil Matra, he's former senior special counsel for digital assets and blockchain technology at the SEC. And gentlemen, good to have you both on. John, I'm going to start with you because I know you have been very critical about just the Wild West as you have described it in the crypto space. It's worth mentioning the numbers again here. I mean, we're talking about a $32 billion valuation earlier this year. They're now trying to cover a shortfall of $8 billion. How much of what's playing out right now is FTX specific? How much of this is a red flag for the space overall?
How can you even know? You call it the Wild West. That's really an understatement, Akiko. It's Walking Dead like anarchy. There's no regulatory oversight, no consumer protections, no licensure, no insurance, no net capital, no transparency, no sunlight. We have no idea what's going on inside of these entities. And if SBF is actually using Alameda, which all of the allegations seem to be leading to, as his personal piggy bank for whatever he wants to use it for, this is very serious because you're not just talking about SEC violations. Right now, the Department of Justice is getting together. I was just at the FBI on Friday in a big meeting just relating to some general concerns about cyber and crypto. And these people are all mobilizing right now. Search warrants, arrests, all of those things are going to happen very quickly. The whistleblowers are mobilizing. The informants are mobilizing because they're seeking immunity. This is worse than Theranos. This is worse than Madoff. If what I'm reading is true. That's my opinion.
Worse than Madoff?
Yes, absolutely. Because in this case, you're dealing with all sorts of investors, all sorts of, look at these financial entities who have had to write down their entire investments. These are supposed to be some of the most sophisticated people around who conducted due diligence on these things. But due diligence in the world of crypto, it's like proving what a poltergeist is wearing. These kinds of things, you can't figure them out. Look at some of these companies, you don't even know where they're headquartered. You don't even know who works there. There's absolutely no transparency. And the contagion is quickly, rapidly spreading amongst all of the various crypto ecosystem. And that's a serious, serious problem for anybody who's doing anything in crypto. I'm sure the SEC will be sending teams of examiners to all of these regulated entities to find out exactly what their exposure is, if there is any. And the enforcement division is probably standing down while the DOJ is doing their criminal investigation, which might involve informants and search warrants and arrests. And the SEC can't really interfere with that. And they don't want to get situations where you're taking testimony by two different governmental entities.
Neil, you're a former insider at the SEC, and I'd be curious to get your take on the impact here to customers. We've got this banner here on the screen. Obviously, the SEC, the CFTC now investigating FTX's handling of customer funds. We know the FTX halted withdrawals of fiat currencies as well as crypto. I mean, what kind of protection is there in place right now for those customers who are saying, how do I get my money out?
Not a whole lot. And I will echo John here. I think that this is a disaster, especially for retail customers. And, Chair Gensler of the SEC has said on multiple occasions that he thinks that these platforms need to be regulated like national securities exchanges. He's expressed concerns about how they handle custody. He's expressed concerns about whether they have protections in place. And if you were setting up a hypothetical to prove him right, you couldn't do better than what has sort of just happened with FTX. So, there are questions here regarding whether FTX and its sister firm Alameda, as they've just discussed, whether there have been sort of flows of funds between them that perhaps shouldn't have taken place or that are questionable. There are questions around whether customer funds have been used, whether customer funds have been moved out of custody, and if you look at FTX's terms, they say pretty clearly for the standard FTX sort of retail trading product. I think the terms say pretty clearly that customer funds are customer funds; they can't be moved without customer permission, and so there are going to be questions raised around whether the terms were sort of complied with in this case. So a lot of the protections that people have were contractual. They had terms of service with sort of that they signed up to with FTX. What happens if those are violated? You have a breach of contract against an institution that's basically could be looking at bankruptcy. So you just don't know how strong those contractual protections are. In terms of federal protections, I mean, until you're a registered national securities agency, you don't have a lot of protection. You might have protections in terms of fraud, where the DOJ can come in, but you're not really under the SEC umbrella.
Neil, we had a guest on yesterday, Peter Chair from Academy Securities, who said that he thinks this is going to trigger a bit of a land grab from regulators as to what should be defined as securities. And I wonder if you take that thesis, how much of this could have been avoided if, crypto, you look at some of these exchanges, they had all fallen under the same kinds of regulations that are applied to securities.
Well, let's take that. Let's break that down. I think that when you look at exchanges and broker dealers, I've been writing since like 2017 that they should have to register with the SEC like everyone else. And as Neil said, these people they're not customers. They're going to become unsecured creditors. Now, I worked in the Division of Enforcement for almost 20 years, 11 years as chief of the Office of Internet Enforcement. And I can tell you the SEC has brought over 100 cases, and they haven't lost a single one in the area of crypto. And they've been very, very aggressive in enforcement. They've experienced incredible criticism for doing so. Hester Peirce, one of the commissioners, they call her the crypto mom. The SEC brings a case against BlockFi unit. Hester Peirce says they received fair notice of the SEC rules and regulations, that defense was useless, weak, pathetic, absurd, and wholly dismissed. So I think the SEC's been very active here, and they're going to get more active. My view is they're going to sue more of these exchanges, probably, again, in my opinion, starting with Coinbase.
Neil, you agree?
Yeah, I think I largely agree. The SEC has been aggressive in enforcement. It sort of said, outside of the enforcement context, it's talked about how it needs to go after these exchanges and make sure that they're sort of registered. But when enforcement is a whack-a-mole problem, because it takes years to build a case against a sizable entity like an exchange. And, you shut one down, there's still 100 more operating. A lot of the money just gravitates over to the next exchange. So enforcement is a powerful tool, but enforcement has its limitations. And so, really there's going to have to be a question here whether Congress or one of the regulators or someone steps in to essentially just make sure that there's umbrella regulation of all of these platforms that are trading crypto.
Finally, John, as we're watching what's